Nobody has to do business with Lehman or any other institution. Once they lose confidence, it's all over.
Banks are the solid foundation of our financial system. But what happens when that foundation starts to crumble? On March 10th, chaos erupted at Silicon Valley Bank. A significant lender to the tech industry fell victim to a classic bank run, the biggest failure of a US bank since the global financial crisis. Customers were frantically withdrawing their money, creating a domino effect that would have disastrous consequences for weaker financial institutions struggling to keep afloat. And just when we thought things couldn't get any worse, a second US regional bank, Signature Bank, has been shut down, and a third, First Republic Bank, FRC, had to be propped up. Why do these banks fail? What are the risks they pose to the financial world as a whole? In this video, we will examine all of that and much more. What are bank runs? Picture this: a long line of frantic customers snaking around the block, all desperate to withdraw their money from a bank before it's too late. This is the scene of a traditional bank run, a phenomenon that occurs when customers lose faith in their banking institution and fear that it may become insolvent. The fear is so great that customers are willing to risk losing their funds rather than leaving them in a shaky bank's hands. Despite the existence of deposit insurance schemes designed to protect depositors, the potential loss or inability to access funds can often outweigh the customer's trust in their institution. This can create a vicious cycle as the bank's ability to repay customers diminishes through mass withdrawals, which further erodes customer confidence. Bank runs have been a recurring feature of financial crises, from the Great Depression to the recent global financial crisis. And most recently, the collapse of Silicon Valley Bank has shown just how crazy a bank run can be for any country in the world. What triggers a bank run? Trust is the cornerstone of any successful bank. And when that trust is suddenly diminished or lost, it can send shockwaves throughout the financial system. Despite the stringent global banking regulations today, bank failures are not typically the cause of bank runs. Instead, public fear often drives customers to withdraw their funds en masse, leading to a depletion of liquidity and potentially pushing the bank toward insolvency. Managing daily reserves is a crucial function for any bank. But when too many customers withdraw money, this treasury function can quickly become strained. As withdrawal requests exceed the planned reserve, the risk of default increases, creating a vicious cycle that can perpetuate even more withdrawals. If customers perceive a rising threat, they may be more likely to withdraw their funds, further exacerbating the situation. It's a delicate balancing act for banks to maintain the trust of their customers while also managing their daily reserves. But when that trust is lost, it can spiral out of control, leading to potentially catastrophic consequences for the financial system. Has this happened before?
By October 1929, the inevitable happens. The stock market loses 12 times more money in 3 weeks than the US government uses in a year.
The entire country could have gone down, and almost did, from an economic point of view.
Bank runs have plagued the financial system throughout history, often triggered by customers' sudden loss of confidence in their banking institutions. The 1929 stock market crash in the United States is a stark reminder of the devastating consequences of a banking panic. As investment and consumer expenditure decreased, unemployment rates soared and industrial production declined. Rumors of an impending financial crisis began to spread. A wave of banking panics exacerbated the situation, with anxious depositors rushing to withdraw their funds from banks. As a result, banks had to liquidate loans and sell off their assets to meet the withdrawal demands. During the Great Depression, many bank runs occurred, with each news of a bank failure triggering a wave of others as customers rushed to withdraw their deposits. The challenge during bank runs is that banks rely on customer deposits to make loans and investments. As such, the bank's assets are only sometimes liquid enough to support a sudden rush of withdrawals, which can create a cash shortage. In December 1930, a bank customer visited the New York branch and attempted to sell his stock in the bank. The bank advised him against selling, claiming it was a good investment. However, the customer left the bank and began spreading rumors that it was facing insolvency and had refused to sell its stock. Within hours, customers began lining up outside the bank to withdraw their deposits, totaling $2 million in cash. Fast forward to the global financial crisis, which saw many institutions fail due to liquidity shortfalls. The crisis resulted in the highest number of bank failures in the United States in the last 20 years, with a combined total of $374 billion in assets at the peak in 2008. These failures are attributed to various factors, including risky lending practices, inadequate risk management, and the widespread use of complex financial instruments poorly understood by regulators and investors alike. Also, Silicon Valley Bank, one of the giants of the banking industry, with a staggering $209 billion in assets, suddenly collapsed in 2023. Customers were frantically withdrawing their money, causing a classic bank run that eventually overwhelmed the bank's liquidity and capital. The cause of the run? A sudden withdrawal of $42 billion by nervous customers who feared for the future of their deposits.
We spoke to a few other investors, we spoke to friends. I mean, this is like calls going off the hook for the last 36 hours. When we felt confident that this was going to be a crisis, Audrey acted fast. And this is the kind of fear that actually incites focus. We withdrew the money through transfers and wires.
Silicon Valley Bank was no ordinary institution, but one that catered to the unique needs of startup businesses in the technology industry, reliant on equity and cash injection instead of traditional financing. This failure was the highest in over a decade and the second highest in history, eclipsed only by the colossal collapse of Washington Mutual in 2008, with a whopping $307 billion in total assets. Is there a solution to this? A feasible technique that banks may use to mitigate a bank run is to inform and educate customers. A bank can communicate with its customers to reassure them of their financial health and the safety of their deposits. This communication can include statements of the bank's liquidity position, deposit insurance coverage, and actions the bank is taking to address the situation. A bank may also impose temporary withdrawal restrictions to slow down the pace of the run. This technique is usually implemented as a last resort, as it can further exacerbate customer anxiety and lead to complete loss of customer trust in the institution. However, it may be necessary to protect the bank from a liquidity crisis and allow it to restore confidence and stability. In the long term, banks can reduce the likelihood of a bank run, such as maintaining adequate liquidity and capital, diversifying their customer base and product offerings, and developing contingency plans for crises. Another option for a bank facing a bank run is to borrow money from other banks or the central bank. If a substantial sum of money can be loaned to the bank, it can prevent the bank from going bankrupt. The central bank is sometimes referred to as the lender of last resort, with the responsibility to safeguard the soundness of banking institutions by loaning money to struggling banks and preventing a wave of bankruptcies that could have a cascading negative effect on the banking system. In 2023, the Federal Reserve announced a new short-term bank term funding program, BTFP, to provide liquidity to institutions needing funds to meet their obligations. The U.S. Department of the Treasury guaranteed the Federal Reserve up to $25 billion under this program. That ends our video on bank runs. What do you think? Are these bank runs avoidable in totality? Or will we continue to face financial threats in the next few years? Leave your comments below, and don't forget to like, share, and subscribe to our channel.